From the University of Westminster, this is The Week Ahead with Dave Coker.
Good afternoon, guys. It's Sunday, January 24th. My name is Dave Coker. This is, of course, The Week Ahead. Let's see what's going on over the next 5 trading days that could impact the markets. Some key events to keep in mind. First of all, we got US GDP coming out. We saw a very sharp 33.5 or 33.4, I believe it was, percent decline in Q3. Q4 is expected to come in at roughly 4% or so. We'll have to see what happens there. It's very important to look at this. We've got earnings coming in for Q4 as well. And once again, now we're starting to see on the back of Netflix really amazing earnings report last week, we're expecting to see some of the tech companies report. So we've got Apple coming in, Tesla's coming in, I believe Microsoft is coming in. There's a bunch of them. So pay attention to that. We could expect to see the tech sector dominate again, and roughly $6.1 trillion in market cap could go higher. France, Germany, and Spain are reporting economic data as well. We expect to see a fairly sharp contraction in Germany of some 5%. Not so sure about France and Spain. The World Economic Forum, it's online, like many things are this year, and that's kicking off later this week. Pay attention to it. It's all online. There's actually no reason why you can't get a lot of good insight about what they got planned for us. I'm not saying it's good, and then we've got a Fed meeting, and we'll get more details into that when we get into the daily. Let's take a look at the S&P 500 year to date. Now we can see here, this is all broken down by sectors. This comes off the wonderful FinViz site, heat maps they're called. And once again, you know how to read this. Red to green, red is bad, meaning we're seeing declines. Green is good. The brighter the green, the higher the increase. You can see this if we take a look on the right-hand side, consumer cyclical or automakers. And you can see Tesla's up some 19.98%. Really stunning rise in Tesla. And then you can see down here, down in financial credit services on the other side, we can see that we've got Visa and MasterCard both seeing declines. And MasterCard's is about 7.83%. Now we do need to pay attention to this, guys, because there is something called the January effect. And basically the January effect posits that as the performance of the stock market in the first few weeks. Now, some people look at the entire month of January. Other people look at the first 2 to 3 weeks. We're looking at the entire month here. And the idea is if these markets tend up in January, then the entire year will be finished up as well. Take a look at the performance of the Russell 2000, the NASDAQ, the S&P 500, and the Dow. The Russell 2000 small cap stocks really kicking it up some 9.82%. And you can see here the S&P 500 isn't doing too bad itself, 3.71%. And then the two laggards are coming in, the NASDAQ 100 as well as the Dow, bringing it up at 227 and 1.38. As long as it's positive, that's what counts. Now, I made up a word here, frothy markets getting frothier. This is interesting because we know valuations in the market are really extreme at this point. And yet we can see a lot of this stuff is just not done on cash, it's being done on margin. Check this out, guys. It's really wild to take a look at this stuff because we're seeing margin debt swinging up, really taking off significantly. And you can see there were big increases over the past 8 months. I didn't do this. The person that does this, I can't recall his name. It was off FinTwit. And you can see that when we start to see margin debt soaring like that, a lot of times we have these epic crashes that follow up. And it's not that long. The difference isn't that long if you take a look at it over time. It's, once we start to see these big run-ups in margin debt, that's when you start to see a lot of bad stuff happen. Because effectively what's going on is people are borrowing money to buy stocks. They're doing so in the expectation, the belief, if you want to call it that prices are going to come up, prices are going to increase in the future. Will they? Who knows? I'm a little dubious myself. Lots of people are. Some people blame retail stockholders for this speculative wave that we're seeing, the speculative frenzy. And there's a lot of evidence that they've moved on from cash positions and they're going into call options. Let's face it, you get leverage with call options. Of course, the difference between buying stocks for cash as well as, or compared to, I should say, buying call options, is that when you're doing call options, you've got nothing, guys. You've got a derivative instrument and the value is tied to the underlying asset. If that thing turns south and drops, say, 5-10%, you could get wiped out totally. If you buy the stock, at least you still have the stock. It's just priced a little bit lower. So again, this is evidence, further evidence of the markets being sort of out of control. We know they're very detached from the economic environment, the real world, to use that phrase. And Jeremy Grantham predicts a plunge in the markets. This is off Bloomberg. You can find the story. And you can see here, guys, 1929, the great crash in 1929, markets were down some 90%. And I suggest you read Galbraith's The Great Crash in 1929 to get some insight into that. Really amazing. So he's saying we're going to see something that's going to be on par with the Great Crash, or could be. He's not totally definitive. Could be on par with the Great Crash in 1929. Know what you own and own it because you know it. I only buy dividend-paying stocks. I'm not particularly worried if there's a market crash. The ability of a company to pay dividends is largely unrelated to their share price. So it's bring it on. I really don't care. Oh, I got gold and silver and Bitcoin too. So lots of fun there. What about the Fed? Well, the Fed is just pumping and printing money. And we've got different ways we can measure the supply of money, M1 and M2. We're not going to talk about them in detail here, but just to give you an idea, M1 is a relatively narrow measurement. We're looking at cash and cash equivalents. And you can see what we're doing here is we're looking at the percentage change from a year ago in these two indexes. And you can see when I went back to 2019, my gosh, it's absolutely incredible, the rate of change, how it's actually accelerated. And we talked about this last week. Remember, roughly 21% of all US dollars in circulation have been printed over the past 6 months or so. And once again, guys, when you see charts like this that are annotated with the yellow, that's my research that I sell to my clients, and I bring it in and give it to you guys in these videos. All right, what's going on overall? Let's get into the daily stuff. At 0830 hours on Monday, January 25th, the Chicago Fed National Activity Index, prior was 27. We don't have a forecast. It's relatively low, though. It's nothing really to brag about. At 11:30, we've got some fixed income. The Fed's coming to market, or Treasury's coming to market with some auctions. 3- and 6-month T-bills, 2-year note auctions. Now, what I've done here is I've gone back 5 years, and I've actually charted out the yields on these instruments. And you can see they were trending up, and that's actually healthy. That's what you expect to see during an economic recovery. Interest rates trending up. It's very, very positive. Now, we see over here, when we go back roughly a year ago, first quarter of 2020, we see yields sharply fall. And this was due to the corona crash. People rushed into safety meaning risk-free assets printed by the United States of America. So as price goes up, yield, of course, falls. And we saw that we dropped down significantly. We're not much better off now when you take a look at what these have traded for prior. We don't have a forecast, but 3 months was going for 8.5 basis points, 6 months was going for 9.5 basis points, and the 2-year was going for roughly 13.7 basis points. That's absurd. I don't know why anybody is buying U.S. Treasuries at these prices. Well, actually, I do know why. There are some market participants who have to park cash, and they do get a subtle or a slight uplift compared to banks if they move into treasuries. And also, they may be buying because maybe on the 2-year side, for instance, they know they're going to have to park the money for a couple of years, and it's pretty safe if you put it into a 2-year note. Unfortunately, it's a very, very low return. On Tuesday, January 26th, got the house price index year on year for November coming up. Now, this gives you an idea, and we talked about it last week, about the blistering hot U.S. housing market. Year on year, guys, 10.2% increase. At 900 hours, we've got the S&P Case-Shiller house price index. It's a composite index, 20 metropolitan areas. We're looking at year on year here for November, and the prior was 7.9. Forecast to come in at 8.1. So that corroborates what we saw with the house price index that we picked up earlier. And at 10:30 hours, we've got Texas services sector outlook for January. Now, somebody asked me a few months ago why I look at this. I look at this because Texas is the second largest state by GDP in America. So we do have to look at California. We do have to look at Texas. We have to understand what's going on with these bellwether states. They do contribute, I should say, significantly to U.S. GDP, as well as tax revenue and things like that. But we're expected to see a 4.3% drop. On Wednesday, January 27th, at 0830 hours, durable goods orders, month on month. Now, Prior was 1.0. Forecast is coming in at 0.9%. Yeah, this is not really a sign that the economy is booming again. 10:30 hours crude oil inventories, another drawdown we saw last week. We don't have a forecast. It will likely be the same thing. Cushing crude oil inventories coming in at 10:30 as well. Prior was a 1.97 roughly million drop in inventory. We'll have to see what happens. The big one, at 1400 hours, FOMC statement and interest rate decision. So the Fed Open Markets Committee, the rate setting body, are going to announce their decision. We're currently at 25 basis points. We expect to stay at 25 basis points. Nobody's expecting an increase. I hate to say it, but it wouldn't surprise me if they did cut. But we'll have to see. The consensus right now is that they're going to stay at 25 basis points, but it wouldn't surprise me, given economic growth and Mr. Biden's plans, if they did do a cut. Could be 10, 15 basis points. At 1400 hours, we got the press conference as well. Try to watch the press conference, guys. If you can't watch the press conference, definitely get the statement, download it, and read it. And again, every week we talk about, or we look for FOMC members, voting members. We look for them in their presentations. I try to identify them for you. We're not surprised with what the Fed does. We're not surprised with the statements. Why? Because we listen to the speeches of the individual FOMC governors, the voting members, that is. And so we get a good feeling for what they're saying privately in that room. Thursday, January 28th, we got US GDP quarter on quarter. As I mentioned, this is Q4 data coming out. Prior was a 33.4% increase. BAFO, huge increase. Of course, it collapsed significantly, so that's sort of meaningless. Forecast to come in at 4%. It's expected we're going to see a contraction in 2020 GDP of roughly 4.5 to maybe 5% in the United States, a stunning drop. At 0830 hours, initial jobless claims. Prior was 900, forecast to come in at 878. Once again, guys, this is 878,000 people who are making their initial claim for unemployment. It's a breathtaking number, and unemployment is really bad in the States. It's even worse than what is reported in the media, because the media, remember, tends to focus on a measurement called U3. Take a look at U6, and I'll present on that next week for you guys. It's amazing because U3 is very constrained. You have to be unemployed, I believe it is, for 2 weeks, and then you're only counted for a certain number of time. When you fall off of U3, you move into another tier, and it's really bad in the States. The data just doesn't give you an actual idea about how bad it is. At 0830 hours, we got jobless claims, the 4-week moving average. As you know from last week, I've mentioned, I do prefer to look at this. It's a little bit of smoothing function, and it's 848,000 people making their initial claim for unemployment. And Friday, January 29th, 0830 hours, we've got core PCE, the personal consumption expenditure price index. Year on year for December, prior was 1.4, forecast to come in at 1.3. When we talk about core, they're stripping out some very volatile sectors like energy and food. And so they're reporting on other aspects of the price index. At 0830 hours, we got personal spending month on month for December. Prior was a 0.4% contraction, forecast to come in at a 0.4% contraction. Not good, guys. Keep in mind, roughly 70% of US GDP is driven by consumption, by spending. When people are afraid, even if they have money, they don't spend money. And if people don't have money, clearly they can't spend what they don't got, what they don't have. And this is a challenge Mr. Biden has, not only to put money into people's pockets, but to change the mindset. So when people do receive money, they don't save it. They go out and spend it and stimulate the economy, try to get stuff moving. At 1000 hours, we got the Michigan 5-year inflation expectations. Now, this is interesting because prior came in at 2.5%. Forecast now is 2.7. We can see what this measures is that it measures an idea of inflation out in 5 years. And we can see that market participants who were surveyed for this expect to see inflation increasing. This is coming in for January, right at the end of the month. All right, guys, this is the week ahead, or this has been the week ahead for January 24th. Now, there's absolutely no reason you can't go forward and make money. So take a look at what I've suggested you look at in terms of metrics. Use mine, augment mine, replace mine totally. It doesn't matter. I look at these things because they're important to me, the way I invest, Come up with your own list and develop your market awareness. It's extremely important. Once again, guys, have a very profitable week. Take care.